Monday, May the 12th, 2025. Welcome, everyone, to the 36th installment of Finwell Daily Brief.
Great to be here.
Let's kick things off, as always, with our financial fact. And this one's quite telling about saving habits here in India.
Oh, what do we got today?
Get this, over 70% of Indian households prefer fixed deposits as their #1 savings instrument.
Wow, 70%. That's substantial.
It really is. It speaks volumes, doesn't it? About that cultural inclination toward, well, low-risk investments.
Yeah.
People really trust those guaranteed returns.
Absolutely. That preference for security, for predictability, it's a really strong undercurrent in the Indian investment psyche. And it's crucial context for understanding market reactions, especially on days like today.
Exactly. Something to keep in mind as we dive into today's market close. So let's look at the numbers, shall we? As of around 3:30 p.m. IST.
Let's do it. Big day, it seems.
You could say that. The Nifty 50 closed at 24,924.70. That's up a whopping 916.70 points.
Wow.
Yeah, a massive 3.82% surge.
Okay, that's significant. Very significant.
And it wasn't just the large caps. The Nifty Mid-Cap 150 finished at 20,331.50. That's a gain of 735.25 points, or 3.75%.
So strong performance in the mid-cap space, too.
Definitely. And the small caps, they're absolutely on fire. The Nifty Small Cap 250 closed at 15,684.20, climbing 603.75 points. That's a full 4.00% jump.
4%. Okay, so really broad-based buying enthusiasm today.
It seems like it. Even the Nifty Total Market Index reflects this, closing at 12,640.60, up 472.55 points, which is 3.88%. It felt like a rising tide lifting almost everything.
That kind of broad participation across large, mid, and small caps often points to a major sentiment driver, wouldn't you say?
I would. And it wasn't just equities moving. Look at the bond market. The 10-year Indian bond yield actually dipped slightly.
Oh, interesting. By how much?
Down to 6.380%, so it dropped to 3.2 basis points.
Lower yield suggests maybe a bit less perceived risk in the immediate term. That fits with the equity rally.
It does. And the rupee also showed some strength against the U.S. dollar, up 0.1% to 84.94.
Okay, so strengthening rupee, falling yields, soaring equities. Everything seems aligned towards, well, positive sentiment.
Exactly. Which brings us to the dominant news, the headline grabber that seems to have really lit a fire under the markets today.
Let me guess. The ceasefire announcement.
Bingo. The unexpected announcement of a ceasefire between India and Pakistan. It was like someone flipped a switch.
You can see it in the numbers. We mentioned the Nifty, but the Sensex surged, what, over 2,200 points?
A massive 2,277 points for the Sensex, yeah. And the Nifty climbed 711 points on that specific news trigger.
Yeah.
Look at the India VIX.
Yeah, fear gauge.
Yeah, just crashed, down by 20%.
20%, that's a huge drop. It tells you just how much immediate tension and uncertainty evaporated from the market's perspective, a rapid reassessment of near-term risk.
Absolutely, and it was fascinating to see which sectors were leading the charge. Yeah. Financials and IT were the clear front runners.
The heavyweights.
Right. But interestingly, pharma stocks seem to face some pressure. We should probably unpack that a bit later.
Agreed. Sector rotation is always key. And wasn't there also news about the India-UK trade deal?
Yes. Good point. Momentum seems to be building there, too. It looks like it's nearing the final stages. So lots happening beneath the surface of that big headline number.
Definitely a lot to dig into.
All right, let's zoom in on some of these key financial and economic stories then. Starting with that ceasefire boost. A 3.5% jump across the main indices. That's a serious reaction.
Undeniably. And you mentioned financials leading the way.
Yeah, the big banks, HDFC Bank, ICICI Bank, they really surged. And the IT majors too, TCS, Infosys, saw strong buying interest.
Makes sense. They're often seen as bellwethers. What about defense stocks? They must have reacted differently.
They did. As you might expect, after their recent run-up, they saw some cooling off, likely profit-taking.
Understandable. The immediate rationale for holding them weakened somewhat with the ceasefire news.
Exactly. But the big question now for everyone watching is whether this stability holds, right? One day is great, but
sustainability is key. Yes, the market's initial relief is palpable, but investors will be watching closely to see if this geopolitical calm persists. Caution is still warranted.
Couldn't agree more. Okay, shifting slightly, that India-UK FTA, this could be quite significant.
What are the potential benefits being highlighted?
Well, the big one is potentially lower tariffs on reportedly 99% of Indian exports to the UK. Think textiles, pharmaceuticals, auto components.
Yeah.
that could really boost competitiveness.
99% is huge. That would certainly open up significant opportunities for export-focused businesses in those sectors, increased volumes, better margins, perhaps.
And an interesting angle for our listeners, especially NRIs. This could create avenues for investing in export-focused ETFs, right? Tapping into that growth potential directly.
Absolutely. The availability of thematic ETFs makes accessing such specific growth stories much easier for investors, both domestic and international.
Now let's talk RBI. What's the thinking on monetary policy?
The consensus seems to be leaning towards a, shall we say, cautious approach from the Reserve Bank on rate cuts.
So no sudden drastic moves expected.
Probably not. Market watchers are predicting maybe 2, possibly 3 small reductions over the course of 2025.
Bringing the repo rate down to what sort of level?
Potentially into the 5.25% to 5.50% range.
Okay. And that gradual easing, that would be welcome news for certain sectors, wouldn't it?
Oh, definitely. Rate-sensitive sectors like real estate and banking stand to benefit significantly. Lower borrowing costs tend to stimulate activity, loans for homes, business expansion.
Right, makes capital cheaper. Okay, let's quickly touch on Tata Steel. Their Q4 earnings preview is out.
Ah, yes. What's the expectation there?
Analysts are forecasting a decline in net profit compared to last year, somewhere in the range of 18% to 46% lower.
Quite a wide range. What's driving that?
Mostly lower global steel prices and perhaps softer demand internationally. It's a cyclical business after all.
True. But what will investors really be looking for in the results?
Debt reduction. That's the key. Any progress on their strategy to deleverage will be watched very closely. It speaks to long-term financial health.
Absolutely. Managing debt is critical in capital-intensive industries like steel. Okay, what about oil?
Crude oil prices seem to have found some stability, hovering around the $80 per barrel mark.
And what's keeping them there?
Partly the ongoing U.S. sanctions on Russian oil supply. For India, stable oil is generally good news, helps manage the import bill.
Helps with inflation calculations, too. But there's always a but with oil, isn't there?
Always. The risk of geopolitical flare-ups, especially in the Middle East, remains a constant factor. That could send prices swinging again very quickly.
Need to keep a watchful eye there, definitely.
And on a more positive note, the tech startup scene here just keeps buzzing.
Funding still flowing in.
Massively.
Yeah.
$1.2 billion raised in just the first quarter of 2025.
Wow. Which areas are attracting the most capital?
No surprises, really. Fintech and AI are leading the pack. We even saw a $200 million round for an AI startup in Bengaluru.
That's serious money. It really shows the immense investor confidence in India's tech potential, especially in these cutting-edge fields.
It does. But even with today's rally, we can't ignore the bigger picture, can we? Those U.S. tariff concerns haven't just vanished.
No, global trade tensions are still a significant overhang. They continue to weigh on overall sentiment, even if masked by today's specific news.
And interestingly, despite the market surge, analysts from places like Citi and Goldman Sachs are apparently still expecting the RBI to cut rates further down the line.
Possibly as a preemptive measure to cushion the economy against any potential negative fallout from those trade issues.
Could be. It suggests they see potential headwinds persisting beyond today's optimism.
A complex interplay of factors, as always.
Okay, let's try and synthesize this a bit. Taking a step back, looking at the market outlook and analysis after today.
Right. That recovery was quite remarkable.
It really was. And fueled by the ceasefire, clearly, but the breadth of the rally was notable, wasn't it? Nifty up 3.82%, strong mid-cap and small-cap gains.
Absolutely. That suggests it wasn't just index management or a few large caps driving things. It points to a genuine release of, perhaps, pent-up optimism across the market. Domestic sentiment seems quite robust.
And the leading sector is financial services, with that huge 38.44% weight in the Nifty, and IT at 12.74%. They were firmly in the driving seat.
Which is often the case in sentiment-driven rallies. They're liquid, globally connected sectors.
But, as we noted earlier, pharma lagged. And that seems tied to those U.S. drug pricing pressures.
Yes, a good reminder that even on a strong market day, sector-specific issues can still bite. Macro tailwinds don't lift all boats equally.
So looking at the broader macro outlook, positives include the potential RBI rate cuts and the India-UK FTA progress.
Definitely supportive factors for the medium term.
But the headwinds are still there. U.S. tariffs, oil price volatility.
Global risks remain. And what about the rupee? It's strengthened today, but what's the longer view?
Well, interestingly, Morgan Stanley was quoted suggesting a potential weakening later in the year. So maybe today was a short-term reaction, something for those with international exposure to note.
Currency movements are always a key variable for cross-border investments. Okay, let's drill down into some sector specifics. Financials.
Look pretty well placed, especially the large cap banks like HDFC, ICICI. They should benefit from easing rates and continued credit demand. Strong asset quality seems key here.
Right. Those with solid balance sheets are generally better positioned to capitalize on growth opportunities when borrowing costs ease.
Now, IT rallied today, yes, but those margin pressures we talked about haven't disappeared.
No, factors like wage costs and potentially slower global tech spending are still concerns.
So maybe selective approach, focusing on firms really pushing into AI, perhaps?
That seems prudent. Companies successfully leveraging AI and next-gen tech are likely better positioned for sustainable growth in the current environment. It's about differentiation.
Okay. Mid caps and small caps, they outperformed today, driven by domestic flows and interest in areas like renewables, infrastructure.
Yes, areas aligned with government spending priorities often attract strong domestic interests.
The valuation question mark remains, especially for small caps. The Nifty small cap 250 PE around 25x, it feels a bit rich in places.
It does warrant caution. The growth potential is there, absolutely, but high valuations increase the risk. Thorough due diligence and selective stock picking are crucial. Don't just chase momentum blindly.
Sound advice. Pharma near-term challenges from U.S. pricing, we covered that,
Yeah.
but longer term.
Longer term, companies with strong R&D pipelines, like a Sun Pharma, could still offer value. Innovation is the name of the game in pharma.
Right. And finally, consumer goods, like Hindustan Unilever.
Generally supported by stable demand, festive seasons help. Input costs seem relatively stable for now. But the key variable there is rural demand recovery. A sustained pickup in rural consumption is vital for broad-based growth in that sector. It's a huge part of their market.
Okay, let's pivot then. Thinking about investment themes for you, our listeners, what stands out?
Well, building on the FTA news, export-oriented growth seems like a clear theme.
Right. Textiles, auto components, maybe pharma despite the current issues, how to play it, maybe broad ETFs like Nifty 50 or Nifty Next 50.
That offers diversified exposure, yes, a relatively lower risk way to participate if the FTA delivers as hoped.
Second theme, digital transformation, India's tech, startup, energy, AI, fintech.
Huge potential there. Higher risk, of course, especially with venture capital. But you could also look at listed tech players like Zomato that are part of that digital ecosystem.
Good point. For those wanting less risk, perhaps defensive plays.
Exactly. Established consumer goods, the large cap banks we discussed, and maybe consider gold ETFs as a hedge.
Yeah, portfolio insurance in uncertain times. Makes sense. Gold can act as a buffer against currency moves and geopolitical jitters.
Precisely. And the fourth theme.
The infrastructure push. That continues to be a major government focus.
So opportunities in mid-cap construction, renewable energy.
Definitely. And again, for diversified exposure, maybe something like the Nifty Mid-Cap 150 ETF could act as a proxy.
It could capture some of that growth potential across the relevant mid-cap names.
Now, crucially, risk management. How should people approach this environment?
Diversification remains paramount. A balanced portfolio, maybe say 60-70% in large caps for stability, 20-30% in mid-small caps for growth potential, adjusted for individual risk appetite, of course.
And consider hedging. With gold, maybe some debt mutual funds.
Yes, particularly given the global uncertainties. Hedging can cushion the portfolio. And importantly, keep monitoring the central banks, RBI, and the U.S. Fed. Their signals on rates are critical.
Absolutely vital to stay informed on that front.
Couldn't agree more. Prudent risk management isn't just about picking winners, it's about protecting your capital, too.
Well said. Okay, folks, before we wrap up, we need to talk about something really important. It's about protecting yourselves.
The beware segment. What are we tackling today?
Ponzi schemes. These investment scams are, sadly, still a threat, and you absolutely need to know how to spot them.
Vigilance is key. These schemes can be incredibly deceptive.
So what is a Ponzi scheme, fundamentally? Well, imagine someone promising you incredibly high investment returns, way above market rates, with little or virtually no risk.
Sounds too good to be true, right?
Exactly. Because it is. In a Ponzi scheme, there's no real underlying investment generating those returns. The organizers simply use money coming in from new investors.
To pay the promised profits to the earlier investors.
Precisely. It's robbing Peter to pay Paul. It creates this illusion of success, this illusion of a high-performing investment.
But it's just a house of cards. It relies entirely on a constant flow of new money coming in.
And that's the fatal flaw. As soon as that flow of new investors slows down, or if too many people try to cash out.
The whole thing collapses, and usually the vast majority of investors lose everything. It's devastating.
It truly is. And these operators, they can be very convincing. They use complex jargon, maybe show fake reports, create a sense of exclusivity.
Anything to build trust and appear legitimate while the fraud continues.
So how do they operate? They might promote these opportunities through flashy seminars, social media, even word of mouth within communities.
Leveraging trust and social networks.
Right. Early investors get paid, which seems to validate the scheme. But again, that money is just coming from the next wave of victims. And they often pressure you, really pressure you to recruit friends and family.
That recruitment aspect is a huge red flag, common to both Ponzi and pyramid schemes. Legitimate investments make money from actual business activity, not just from bringing in more people.
So what are those glaring red flags? Things that should immediately make you suspicious?
Well, number one has to be that promise of guaranteed high returns with little or no risk. That combination just doesn't exist in legitimate finance.
Absolutely. Risk and reward are intrinsically linked.
What else? Lack of transparency. If they're vague or secretive about how they actually generate returns, or if the strategy sounds overly complex or nonsensical, be very wary.
Right. If you can't understand it, don't invest in it. And that pressure to recruit.
Massive red flag. If your returns depend on you bringing others in, run away.
And finally, difficulty withdrawing your money. If there are delays, excuses, problems getting your funds out.
That's often a sign the scheme is under stress and nearing collapse.
Okay, so how can you, our savvy listeners, protect yourselves?
First and foremost, verify. Check the credentials of any firm or individual offering investments. Are they registered with SEBI or the RBI? Do your homework. Don't just trust them.
Crucial first step. What else?
Be deeply skeptical of those consistent, unusually high return promises without a clear, understandable business model. Conduct your own due diligence, research the company, the people involved.
And if you're unsure?
Consult a registered financial advisor, someone independent who has a fiduciary duty to act in your best interest. Get a second opinion.
Excellent advice. And if you do come across something suspicious,
Report it. Report it to SEBI, report it to the police. You could be preventing many others from falling victim.
absolutely. Taking these steps can save you and others a lot of potential heartache and financial loss.
Vigilance and due diligence are your best defenses.
Now let's pause for a quick but very important message from our partners at SOS Finwell. Hey there, Finwell listeners. Let me ask you something. Does navigating the financial markets sometimes feel like you're trying to find your way through a dense fog?
Yeah, there's just so much information out there, isn't there? Headlines, data, opinions. It can be overwhelming.
It really can. It's tough to know what actually matters, what signals to follow, and what's just noise. But imagine having a clear guide, a trusted companion on your financial journey.
Someone who cuts through the clutter, understands the complexities, and speaks your language.
Exactly. Someone who keeps their finger firmly on the pulse of the market, day in and day out. Well, that's precisely the mission behind SOS Finwell.
Every day, just like in this briefing, we dive deep. We analyze the market moves, break down the key economic news, and bring you the insights you need.
We want you to feel empowered, confident, and in control of your financial decisions. That's why subscribing to Finwell Daily Brief is so important. Don't miss out on timely trends, expert analysis, and actionable takeaways. Find us and subscribe wherever you get your podcasts.
And it doesn't stop there. Want to go even deeper? Get exclusive perspectives. Connect with a community of fellow savvy investors.
Then you need to connect with SOS Finwell on LinkedIn. It's the place for richer discussions and direct access to expert insights. Let SOS Finwell be your partner in building that secure, prosperous financial future you deserve.
We're here to help you make sense of it all, one insightful briefing at a time. Don't wait, subscribe and connect today. Transition back to regular tone.
Welcome back. Okay, just a quick closing summary of today's key highlights then.
Let's recap.
Indian markets saw a really strong rebound today, the main driver clearly being that unexpected ceasefire announcement between India and Pakistan.
A significant positive reaction across the board.
Financials and IT led the charge, with mid and small caps also performing very strongly. We also noted the positive outlook supported by the India-UK FTA progress and expectations of gradual RBI rate cuts.
But we also flagged some ongoing concerns.
Right. Potential headwinds remain, U.S. tariffs are still a factor, and the pharma sector faces those U.S. pricing pressures.
So the key takeaway.
In these dynamic conditions, Maintaining a well-diversified portfolio and focusing on solid risk management principles remains absolutely crucial.
Today really highlighted how quickly geopolitical events can impact markets, but a long-term, disciplined approach is still the foundation for success.
Perfectly put. And on that note, I want to leave you with a piece of timeless wisdom from the one and only Warren Buffett. He said, "The stock market is a device for transferring money from the impatient to the patient."
Powerful words. Patience truly is a virtue in investing.
It really is something to reflect on. And finally, just our standard disclaimer. Please remember, everything discussed today is for informational purposes only. It's not intended as financial advice.
Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Exactly. Past performance doesn't guarantee future results, and all market data and projections involve risks and are subject to change. Investing always carries the risk of potential loss.
Stay informed, stay cautious, stay patient.
Thank you so much for joining us on FinWell Daily Brief. We'll be back tomorrow with the latest market updates and insights. Have a great evening.
Take care, everyone.